we are going to do IAS 40. IAS 40. IAS 40. IAS 40 is called investment property. Investment property. Now, what is IAS 40? What is investment property? Now, we learned PP, and if you remember, we said PP is a tangible asset that is used in the production of goods and services, for rental and for administrative purposes. But here, it takes a slight different from the PP. Now, when we say a property simply means a land or a building. So take note of that, or part of land or part of a building or both. So that is a property. So understand that this is when we talk about property, we are talking about land. We are talking about building. So there is no way on earth we should call plant and machinery an investment property. So please get to understand these things from now. All right. So that is that. But it's just that it's inside the PP. So they can say the person has an item of a PP. They say the person has an item of a PP. Then it tells you that it is inside land and building is inside PP. So it's there. All right. So that is that. So when we say investment property, therefore, and I'll be shortening it and calling it IP. All right. So when we say investment property, IP therefore is this land of building or part of the land of the building or both. All right. So they are properties. And when I say properties, these are what I'm referring to. So they are properties. And this time round, it is not used for administrative purposes. Neither is it used for what do we call it? Production. So we said that these are properties that an entity, properties held by an entity for held by an entity to earn rentals. Okay, so they earn rentals and capital appreciation. Capital appreciation. So take note of that. So these are properties held to earn rentals or capital appreciation. What we are saying is that if you have an asset and all that you use the asset for is for rentals or capital appreciation or both, that asset is a PP. For example, if you buy a land and you don't use the land to build, but all that you do is that you bought a land, you are just waiting. So you bought the land this year, then next year you will sell it. Why? Because prices of land appreciate. And so if you buy it now, you won't do anything on it. You just wait. Then the next year you sell it. When you do that, it means you kept the asset for capital appreciation. All right. So we say that investment properties are properties held by an entity to earn rentals and capital appreciation or both, other than. So we are taking out the PPE function. Other than one, what are the remaining two of PPE that are two items of PPE that has not come here? Number one, other than, we say that for use by the entity. Other than for use by the entity. So these are not items or assets that the entity use. No. They neither use it for administrative purposes nor for production of it. They don't use it. The company don't use it. All that is that they are keeping it for rental. They give it out for rental, and they wait for it to appreciate. All right. So for capital appreciation. Number two, other than for for sale, they don't sell it to for sale in ordinary course of activity. So it's not a property that they sell. No, 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 no. So distinguish investment property from real estate people, because real estate people sell them. Okay, they sell them. But here we are not looking at those ones. We are looking at the ones that you give for rentals so that you earn money, or you keep it for capital appreciation. So that is an IP. So you need to understand what an IP is. So if in a question they are describing an asset like that, then you know that this one is an IP. That is how you learn it. All right. So that is that. Please, any question at this point before I move on? Any question? Yes. Any question? All right. So in the absence of any question, let's get some examples. What are some of the examples of IP? All right. So we have land that, like I mentioned, land held for capital appreciation. You don't do anything with the land. All you do is that you keep it so that the value will appreciate. All right. So land that is held for appreciation. All right. So, and if you have a land, so let's say land held for undecided future use, held for undecided future use. If you have a land and you've not decided what you are using it for, because you've not decided and the future appreciation is happening on it, it becomes an IP. All right. So undecided future use. That is. Then we have a building that is leased out under operating lease. Please, I didn't say finance lease. I said operating lease. So take note of that. So a building leased out under operating lease. And I'm repeating this. I never said finance lease. I said operating lease. All right. Operating lease. Okay. Then if you have a building, let's say a vacant building. So you have the building. So let's say vacant buildings. So many buildings are in town, they are vacant. And they are held to be leased out. Held to be leased out. So you've not leased it already, but you've held it to be leased out under operating lease. So that one is, it's either you are doing the thing or you are keeping it to do the thing. So that is the meaning. To be held under operating. It's like either you are using you've held the land for capital appreciation, or it has undecided future use. So that is that. And the lease aspect too. All right. Now, with these things in mind, what we are going to do is to take some keynotes, and the keynotes are very, very important. So I'm going to give you about 4 keynotes that you need to pay attention to, because that is where the principles will be coming from. All right. So now the first one is that when you have a property and the property is being constructed or developed for the use as an IP, you see, you've not finished constructing it, but you are constructing it. So the key point out of that one is that when a property is being constructed or is being developed for use as an IP, So you are developing, maybe you are like you've not finished, but you are constructing it. So let me write so that probably you can take note of it. So key point number one, when a property is being constructed or developed for use, as an IP, so as an investment property, what you should know is that IAS 16 will apply until the property is ready for use, at which time the investment property standard will follow. Because you have not completed it, okay, IAS 16 will apply, and you know IAS 16. So when a property is being constructed or developed for use, IAS 16, developed for use as an IP, IAS 16 applies. Until the property is ready for use as an IP. All right. So you have to finish it. All right. So after you have finished, we made ready for use, then the IP IAS 40 will apply. Okay. So please take note of that. Now, I want to ask you a question again, because we are going to look at if you have a property and let's say you have a story building, all right, then let me make it more specific. You have a three-story building, three-floor story building. So it's three on top. And you are using the last two as for rentals. And the ground floor and the first floor as administrative purposes. The standard is saying that because you are using the top for the what we call the rental income and the down for administrative purposes, you will need to separate the asset. So you have to separate the top from the down. You treat the top as IP and the down as investment. The top as an IP and the down as IAS 16 PPE. Because listen carefully, please. The key is that in IP, you are not using it for administrative purposes. The company is not using the asset itself. It is renting it out, or it is keeping it for capital appreciation. But when we studied PPE, we said PPE is what? Asset that is used in the production of an income, used for rental purposes, used for administrative purposes. But when we come to IP, we single out only the rental income and capital appreciation. So if you have some asset, which part is used by yourself, that one will be called PPE. Then the part that you use to earn rental income, that one will be called what? An IP. So IP could be a spare property rented out to a third party, all right, in order to get some gain, okay? So it could be the spare property out of the entire property, all right? So you have to distinguish the property, the part that is used for the rental to earn rent money, and the part that is also used by the company itself. So whenever we are teaching IP, we give PPE a new name. A new name for PPE now becomes owner-occupied property. Owner-occupied property. So that you know that when the owner is using it, that one is a PPE. And IP is when the owner is not using it, but it's actually renting it out. All right. So please take note of that. Take note of that. All right. So my second point is that when an entity occupies a premise, a premise, but rent out certain floors. So like the example I gave you, certain floors, like let's say the third floor or whatever you want, the part of the floor you want to use. Then that part, the part occupied will be under IAS 16. And the part rented will be under IAS 40. So you separate them, okay? IAS 40. So that is it. All right. So take note of that. Now, if you have a consolidated financial statement, a consolidated company, so where it's a group company entity A and B. Now, the parent company or the subsidiary decides to rent part of its building to the parent, or the parent decides to rent part of its building to the subsidiary. Inside the individual account, Obia Diemuno, the part that the parent has rented to the subsidiary will become an IP individual. And inside the group of accounts, that one there, you put it together as a PP. So understand that. See, all that you need to understand is what is the thing? What is an IP? So the moment you know this is an IP, it doesn't matter where the thing is. So far as it is rented or for capital appreciation, then it is an IP. It's as simple as that. All right. So please take note of that. It's very, very important. All right. If you have a group where the parent actually rents the part of its building to, what do you call it? Part of its building to its subsidiary, then it's in the individual parent account. The rented building is an IP, but put together as a consolidated account, it is a PP. So that is what you need to know. All right. So take note of that. Take note of that. So please know that a property held under IAS 16 is not an IP. IAS 2 is not an IP. A property that is being constructed or developed for a third party is also not an IP, because you are not developing for yourself. You are developing for a third party, and it's not like you are renting it. Oh, Obia. So if somebody contacts you as a construction engineer, then you are building for that person. That property that you are constructing is not an IP, because you are not the one funding it. All right. So take note of that. And like I said, everything I said under the leases, I use operating lease. Now, if it is a finance lease, it is also not an IP. That one is IAS 16. You look at that. All right. So take note of that. Now, coming to the most important thing, which is the recognition. When do you recognize an IP? When? Now, when is the same as the PPE own. Okay? Is the same. So recognition is an asset, and all the assets have the same recognition criteria. All assets has two constant recognition criteria for all of them. All right. Number one is that there is probable inflow of economic benefit. Probable inflow of future economic benefit. Associated with the IP, all right, the asset. So the future economic benefits we've been talking about is the one that is associated with the particular asset. So probable inflow of future economic benefit from the asset. All right. From the asset, sorry, from the asset to the end. Then the second one is, as usual, reliable measurement of cost. So if you can reliably measure the cost, then it means that you are good to go. Measurement of cost. All right. Then we come to the measurements criteria. So that one too, there is initial measurement, there is subsequent measurement. I told you that when it comes to measurement, these things, you have to be very, very careful. All right. So let's do the initial measurement. The initial measurement for every asset is at cost. Initial measurement is at cost. And please, when I say cost, by this time you should understand what cost means. You've done PP, you know cost. You know, we'll be talking about purchase price, less discount, and all those things. We will be talking about the direct expenses. By this time, you have all those things. Then any future cost of dismantling. So the three elements of cost. All right. So those are what we call cost. All right. Now, then we move on to the subsequent measurement. Subsequent measurement. So that thing stop the examiner from asking you an IP question where you calculate the cost like the way you do for PP. I told you that when you are constructing an asset, so please, these are things you should listen carefully. I told you that when you are constructing a property to be used as an IP, IAS 16 will apply until the property is made ready for you. So when you are constructing, IAS 16 applies. Everything for the cost, IAS 16 applies. All right. So we look at the subsequent measurement. As for the subsequent measurement, this one too, just like the PPE, you saw something of a choice. Here too is the same. It's either you use the cost model, and please, this is the place I will need you guys to listen carefully because we will be very soon solving the question. So you tell me that because we said it when you were explaining it, then that's how we are doing it. All right. So we have the cost model. And you remember the cost model also from PPE. Then number two, we have the fair value model. Fair value model. All right. So as for the cost model, it's as simple as ABCD. So we are using the historical cost. So all you need is the historical cost. So you will need the historical cost. Then you will less accumulated depreciation or accumulated impairment. So accumulated depreciation or accumulated impairment, you less them. Yes, of course, you get your opening carrying amount like we did in PP. Then you less current year's depreciation or current year's impairment. So you less it, then you get your carrying amount. And this is the key thing you should know. When you use the cost model, no revaluations are permitted. A very, very key point. You should take note of that. No revaluations are permitted if you use the cost model. You are not allowed to revalue the asset. So this is a very key strong point. Take note of that. Now, what if you decide to use the revaluation model? Okay, if we use the revaluation model, then we will be looking for the fair value. You'll be using the fair value. Instead of cost, we'll be using the fair value. And we all know fair value under IFRS 13. Is that not it? You've done that. IFRS 13. Okay, so which means that you'll be using an active market. Okay, so that is that. And you know everything under IFRS 13. So you'll be using an active market. All right, so that is that. And key point number 2, let me use red. Key point number 2 is that when you use the fair value model, you don't depreciate the asset. So no depreciation is charged. So you don't depreciate the asset. When you use the fair value model, you don't depreciate the asset. Key point. All right. Key point number 2. Number 2. All gains and losses. All gains and losses on revaluation goes to the statement of profit or loss, the SPL. All right. That is that. Key point number 3. The carrying amount of the asset, like for this one, carrying amount is equal to the closing revaluation. So the last revaluation that they did becomes the carrying amount. All right, so take note of that. Please, any question at this point? Any question at this point? All right. So the standard says that where it is impossible for you to use the fair value model, then please use the cost model. All right, use the cost model. Where it is impossible for you to use the revaluation model, please go back and use the cost model. All right. Now, let's talk about the last part of this standard. The last part of this standard. And I'm going to explain it to you. There are just 4 points we are going to make. Then we start solving the questions very soon. All right.
Hello, sir.
Yes, please.
What would make it impossible to use the revaluation method? What
When
would
you
make it?
can't have an active market, those things we did in IFRS 13. When you can't have an active market, you remember level 1, level 2, level 3. Do you remember that those things we did under IFRS 13?
Yes, please.
Yes. So when you can't have the level 1, the standard is saying that use the cost model. All right. Please, is that okay?
Yes, sir.
All right. Unless you have forgotten what level 1 is about. So that is that. Please, you said I should scroll down. Is that Julia? All right. So please, this is it. Let's move on. Let's move on. Of course, you will definitely have your book and all these things. And Monday you have it, and you also probably can watch this video in 10.
Hello, sir. The
Yes,
book,
please.
if someone wants to come to you for it, where can we meet you?
Don't worry, that one will after the class.
Okay.
After this one. All right. So let's move on. Let's talk about the last aspect of this standard. We talk about transfers. The transfers. Okay. So now, transfers talk about this, the switching from the PPE to an IP, IP to PPE, IAS2 to IP, IAS40 to IAS2, so IP to IAS2. Now, if I have an asset, so we say point one, from PPE, which is IAS16, owner occupied property, to an IP, what do you do? What do you do? So you apply, we say apply IAS16 up to the date you are doing the transfer. So apply IAS16 up to the date of the transfer. All right, the date of change. So if you are transferring an asset from a PPE to IP, apply IAS16 just as you know, your depreciation, everything you know under IAS16. All right. Now, but on that date that the transfer is happening, at date of transfer, at the date of the transfer, what you do is that at date of transfer of the PPE, you have to revalue it to its fair value. So you revalue PPE at fair value. And any revaluation surplus, you know revaluation surplus. So any revaluation surplus will be treated under IAS 16. Is treated. And what is the treatment for revaluation surplus in IAS 16? Yes. Where does it go? Where does revaluation surplus in IAS 16 go? Hello, class.
So it goes into the revaluation account treated under the equity.
In the P&L, when you are doing statement of P&L and OCI, where does revaluation surplus go?
OCI.
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 All right. Then what you said is when it is in the balance sheet or when it is in the statement of changes in owner's equity. All right. You are not wrong. It's just that we want the PPE side, the SPL and OCI side.
Okay.
All right. So take note of that. Because when you put it at the OCI, what you mentioned is the corresponding entry. You will later take it there. But between the asset, when there is a revaluation surplus, you debit the asset and you credit OCI. Please, is that okay? Sheila, did I hear you say something?
No, please. I said OCI.
All right. I heard a voice. Okay. So number two, so please, from the revaluation date, as you have done, you finished doing the transfer. So from that date going, it now becomes an IAS 40. So from the date of the revaluation or the transfer, so we call the transfer date a revaluation date. So from the revaluation date, this OCI means other comprehensive income. All right. So from the revaluation date, you now apply IAS 40. All right. So that is that. So what is IAS 40? It means you need to, when you have to do fair value, you do fair value. When you have to do cost model, you do cost model. But now that you have revalued it, it means you have chosen the revaluation model. So under the revaluation model, do you remember the things I said under revaluation model? This is it. Do you remember? And please keep, that's why I've written it in red. When we start the questions, these are what I want you to remember. Okay. So that is that. Now, point two is when you have IAS 2 and you are transferring it to IP. So from IAS 2, somebody will say, but sir, you said Adene is only buildings and what do you call it? And land. So how does IAS 2 now become something we can transfer to IP? What IAS 2 is inventory people hold or people trade in their ordinary course of activity. So that is IAS 2 that's the inventory. If you go to the real estate people who are selling buildings, the buildings is not an IPO. It is their inventory. That is what they do. Just as the tomato seller is also selling tomatoes in his market. So that thing they do as their ordinary course of activity, that buildings they are selling as their ordinary course of activity, it is their inventory. So please, principle applies. Okay. So when you are converting it from that IAS to an IP, then it means that the same thing, you have to do a fair value. All right. And with any fair value. So watch this. From IAS 2 to IP, it is carried at fair value. So carried at fair value. And please, at this time, I'm not going to, it's not this time I'm going to explain fair value again. No. That's why we start from coming from behind. All right. So that when we mention the term, you get it. I'm not going to teach fair value all over again. No. So when I say fair value, you should understand what I mean. All right. So you carry it at fair value. All right. Then any change in the carrying amount caused by the transfer will go to the P&L, not OCI, P&L, because this one is IAS 2, not IAS 16. All right. So we carry it at fair value with any difference between the carrying amount and fair value going to the SPL. All right, statement of profit or loss. Then point 3, what if it is an IP? What if I have an IP and I'm taking it to IAS 2 inventory? So that one too, the same thing, fair value at the date of change. Fair value at date of change. All right. And from that point, from the date of change, it now becomes IAS 2 because you've changed it from IP to IAS 2. All right. What about from IP to PP? What do you do? That one too, the same thing, you do fair value at the date of change. And IAS 16 applies from that point onwards. So fair value at the date of change and IAS 16, because you've changed it to PP, so IAS 16 applies afterwards. So basically that is that. So what we are trying to say is that if I have, let's say, this is January 2020, and let me shift this thing to like this. And this date, it's like, let's say this is the date of transfer. All right. And that is like, let's say July 2020. And let's say this is December 2020. Now, at this date of transfer, let's say I'm transferring it to PP. So to PP. What happens is that from this date, up to this date, the thing is an IP. It's an IP. So it will be an IP. And don't forget, there will be no depreciation because we have revalued, we are doing a transfer. All right, the revaluation model is applied. So there will be no depreciation, and then any gain or loss goes to the P&L. Take note of that. Take note of, because an investment property. And on this particular date, that is where we do our fair value. So you determine the fair value. All right, so take note of that. And once you have determined the fair value, and the thing has become PPE as at this date. So from this time going on, up to the end of the year, the thing now has become what? A PP, because you have transferred it here to a PP. So from this time going on, IAS 16 will apply. So it means that you will need to find depreciation because it's IAS 16. And if you check this one, if this is what we are going by, then it means that your depreciation will just be half year. So it will be 6/12 per this analysis. All right. Then don't forget you have your carrying amount. So your depreciation will go to your SPL, and you have carrying amount. That is your cost minus accumulated depreciation will go to your SOFP. All right. So that is that. Of course, what you need to disclose is that you need to disclose the choice. Did you choose cost model or fair value model? All right. And you need to disclose how you determined your fair value. All right. So basically that. So that is IAS 40. Any question before we start looking at the questions? Any question per what I've taught so far? Does anyone have a question on them? Look at the basis of this illustration. Now, you see that Kumasi company owns a building which it has been using as its head office. So if he is using it, what standard applies? If the person is using it, what standard is that?
Hello, sir.
Yes,
Is
please.
it not the IAS 41 that we should open?
No, you follow me, please.
Okay.
Follow me. I said, I'm reading a question from here. It's not in what I've sent you. So you follow me, okay? So this question says, Kumasi company owns a building, which has been using as head office. And I said, when the company is using the building as its head office, which standard is that?
IAS 16.
IAS. All right. All right. And it says that in order to reduce costs reduce costs on June 2019, it moved its head office function to one of its production centers and is now letting out the head office. What does it mean?
It now becomes 40.
All right. You see, this one, nobody is telling you. Because you listen, you're able to figure it out. All right. The company policy is to use the fair value model. So have you seen what you asked? Is the question that tells you. All right. The building, sorry, the building had original cost of on 2010 of 250, and original cost of 250 and was depreciated over 50 years. At June 2019, the fair value was judged to be what? 350,000. So what do? Because it was using it, you need to find out what was the carrying amount up to the date they transferred it into IAS 40, investment property. So you see in this illustration, you find the cost. How much was the thing bought? 250. 2010, 250. And now in 2019, June, where the revaluation has happened, we need to find the revaluation surplus. So you need to deduct all the depreciation, accumulated depreciation, up to the point they are making the revaluation. So from 2010 to this date, how many months is that? How many years is that? And what is the depreciation per year? So if the thing is 250, you bought it 250 and it has useful life of 50 years, then it is 250. Please start punching calculators over 50 years. What is the depreciation for that every year? Now let's count the years also to find out. So from January 2010 means that it will start counting from 2010, 11, 12, 13, 14, 15, 16, 17, 18, 19. How many years is that? And the 19, you can't add the full 19 because you need to end at this date. You can't add the full 19. So you have to count up to January 2019. And when you count up to January 2019, that one gives you 9 years. All right. Then you add half from January to June. All right. So when you do that correctly, you see that for the 9 years, you have 45,000. Because this one gives you 50 per year. So for 9 years, it gives you 45,000. It's 5 per year. Sorry, not 50. So it's 5 per year. So multiply by 9 years, you get 45,000. In the 6 months, we know that every year is 5,000. So 6 months of every year is 2,500. That is what you see here. So now when you now deduct the depreciations, you see this is what you have, 202,500. Then it is this figure that is now revalued to 350. That is what you see here. And I told you, if you listened carefully, if you listened to me when I was doing the principal tuition, you realize that, where is it? You realize that I said something here, that when the thing is revalued, the carrying amount is equal to the closing revaluation. Carrying amount is equal to the closing revaluation. That is, if you listen well. All right. So now going back to the question, what you realize is that this is the carrying amount, and that will be, and please watch this. This one, the revaluation is done at what? June, which means that can't be the final value to the SPL because the account is prepared up to December. So it means from this point, the thing has become what? An IP. And since it's an IP, no depreciation. Remember, any further revaluation, gain or loss will go to SPL. So take note of that. So you see this one, there's a revaluation surplus. So this revaluation surplus is at the time the thing was a PPE before you are transferring it to an IP. So this revaluation surplus will go to the OCI. All right. So take note of that. So you see this question, the explanation is here. The difference between the carrying amount and the fair valuation at the date of transfer is revaluation surplus. So that one will go to the OCI. Then after that date going, the building is accounted for as investment property. What does it mean? It means no depreciation, and any fair value again, will transfer, any fair value again that happens, the difference will go to the P&L, not the OCI. So watch the explanation I gave here. So it says that from after that date of the transfer, the building is now accounted for as investment property and will be subjected to fair value exercise at the end of each year end or at each year end. And this gain or loss will go to P&L. So for example, if at the end of the following year, the fair value of the building is found to be 380, so 350, and it has been fair value to 380, then 30,000 will go to the P&L. All right, 30,000 will go to the P&L. This is FR. So for FR, you read this thing and you understand, oh, okay, so that is that. But in corporate reporting books, you won't see these things. Yes. All right. So now, before we even move on, I need you guys to try this question that you see. Question 1, this one. Everybody, try it now. Everybody.
Just go straight. The PPE, as at January, it was 20,000. So I found the accumulated depreciation, and it's for half a year. That is 6 months. So I got 500,000, and then from there I revalued it. The revaluation, and then the carrying amount I deducted, and I had the carrying amount of 19,500,000, and then I revalued it. As at that time, the revaluation figure was 21 million. So I had a revaluation surplus of 1,500, 1,500,000. That will go to the OCI. And then afterwards, in December, it was revalued again. And the revaluation surplus I had was 600,000. That will go to P&L.
That's very good. So all you need to do is to keep at it and work with speed. All right.
Okay, sir.
All right. Julia, did you have the same thing?
Thomas, please, I'm driving. No.
Oh, all right. All right.
Thank you.
No problem. So that's very good, Emilia. So keep it up. All right. Keep it
Okay,
up.
sir. Thank you.
All right. So
But so if I want to get the book, can I come there for it?
don't worry. You let me finish the class. We'll talk about that.
So okay.
All right.
Hmm.
So that is how IP is. All right.
Okay.
So right now, the only thing I need to do is, so you can now go to the past question that I've sent you
Okay.
and now see how you'll be treating them.
Okay.
Okay. So it's the same principle that you apply. Let's see. We have a little time. Let's see if you can crack one or two.
Yeah.
All right. So
Okay.
just a moment. Just want to upload the question here.
Okay.
All right. So this is the question they have. And this is the one that I've sent to you. So it's either you follow from here or you open from here.
Okay. Okay. Is that Tamsco? A Tanko or Tams?
Tanoso. Or
A
Tanoso.
Tamsco. Okay. Then let me. Okay. Yes. The following properties are this. Okay.
All right. So let's look at this question quickly, then we go. Now, this is a FR question. Like I always say, FR helps you to think so that when corporate reporting, that one makes it an easy Google. It says Thanos owns the following property. And the requirement of the question is that in accordance with IAS 40, calculate the carrying amount to be recognized in the account as at 31st December 2015. Now they have a land with future undetermined. That one we talked about it. I gave you examples of IP. Do you remember?
Yes.
So is this one an IP?
Yes.
All right. Then it says that they have factory rented to town or so subsidiary under operating lease. So they've rented. So this one is saying that. Let me read everything. It says that, yeah, that's it. Factory rented to Tanoso subsidiary, and we are preparing the books in Tanoso. Okay, so it says that factory rented to Tanoso subsidiary under operating lease. So what is that? The company has rented. Is it an IP or it is a PPE in the group? How is it like?
In the group, it will be PP.
In the group, it will be PP. So this one says in IAS 40. So it means that we won't add this one. This one won't be part.
Yes, it's PP.
Okay. All right. So that is that. Then we have 10th floor office building. Fair value is equal per floor.
It's not part. Fair value.
Fair value is equal per floor. Okay, so they are trying to tell us that this is the one I told you that when part is PP and part is IP, you split it. Like I told you, I gave you, I was doing the example for you.
Okay.
So 3 floors is used as the subsidiary's head office, and 7 floors is rented out to a third party for operating lease. So it means that we need to proportionate it and find out the IP part. So already we have the land, which is 3.2. So this one, we need to proportionate it. So that one will be like, so how many floors is used as an IP? If it is 10 floors, then 3 is used by them as head office. Then the 7 that is rented out to third party under operating lease will be
7/10 times.
7/10 times 15. Yeah. So how much will you get for that? Then we put that down. Then what about the empty building held for capital appreciation but not leased out? Is it an IP?
Yes, it's an IP.
If it is an IP, then you add it 4.1. You are done. That's all the question is. You are doing this thing for 3 marks. You see, it forces you to think.
Yes.
As to the things that are IP. And see, this is FRO. By the time you go through this thing in FR and come to corporate reporting, you'll be jumping some of the standards. Yes, that's how it is. But most of you have had exemption, and that is where the problem is coming from.
Yes, it's true.
Yeah. So get me the 7/10 and on the 15.
7 divided by 10 times 1/5.
Is 7 divided by 10 is what?
Times the 15 is 10.5.
10.5. All right. So when you add everything up, I think here will be like 8. And here will be 17, right? 17.8.
Okay. 17.
Yeah. So that is that. That is the question. It looks simple, but you have to think. So somebody will be killing himself about this one. Factory rented to town or so subsidiary under operating lease. And you see, since they are preparing the thing, we said that in the parent book, I mean, in the individual group, in the individual account, that one can be what do we call it? IP. But in the group, that one is a PP. So these are things you need to really understand. I mean, try as much as possible to really understand. All right. You see, the question said we are doing it in terms of consolidated financial statement.
Okay.
Had it be that it has said that we are preparing it in terms of only account, then that thing is an IPO.
Yes.
Because he rents it out. But in the consolidated account, it is a PPE. So you see, it is the principles we are testing.
Yes.
Yeah. And we do this thing in FRO. So corporate reporting, we would jam these standards. We just use 15 minutes, talk about it, we move.
Yeah, I'm not enjoying the standards. So because initially I didn't understand. So when we are doing it, I don't feel comfortable. But when I'm getting the understanding, I'm even enjoying it.
Oh, yeah. That's the truth. When you get the understanding, you enjoy it. So try and tackle the question 2 during the course of the day.
Yeah,
All right.
I'll do that.
And
My
so
only
it's all,
problem is the fair value. I have to go back because the levels and all those things, I didn't get them all. So I have to go back and then do that.
Yeah. Then do that. You'll be fine. So thank you very much. And once you go back, you go over, you'll be fine. And let's move on, because God willing, tomorrow we are going to look at a new standard, very simple like this one. So just follow through. It becomes enjoy.
Yeah, thanks so much.
You're welcome.
So the book.
Thank